This lecture is on the risk and return of individual securities. I'm your professor, Dr. Stephen Haggard. Let's start by talking about returns. Financial securities have two sources of returns. Many securities make payments, as some bonds make coupon payments and some stocks make dividend payments. Also, there is a return from the capital gain. In other words, from selling the security for more than it costs. And so financial securities, therefore, have two sources of returns. Now, for the purposes of our discussion, we will use stocks for the examples in this chapter. We're going to discuss different ways of expressing returns. And the first way is perhaps the simplest. We call it dollar returns. That's merely the returns on your investment stated in dollars. Let's work through an example. Let's say you buy 100 shares of stock at $37 per share. The stock pays an annual dividend of $1.85 per share. At the end of the year, you can sell a single share of the stock for $40.33. So what's your dollar return on that stock investment for the year? Well, we need to figure out what the gain is from both of the sources that we discussed previously. Let's start with the capital gain. If you sold the stock for $40.33 per share, but you only paid $37, that means that you made $3.33 per share. And since you purchased 100 shares, we need to multiply by 100 and find that our dollar gain for the capital gain is $333. Now for dividends. Each share collected $1.85 in dividends, and there are 100 shares, so $1.85 times 100 is $185. And so we can find the dollar returns for holding 100 shares for 1 year to be $333, the capital gain, plus $185, the dividend. That gives us a total of $518. So what's the problem with stating returns in this manner? What kind of information does it ignore? Well, think about this. You're at a party. You're bragging to your friends about the great returns on your stock portfolio, and you say, I had dollar returns of $518. Do your friends know whether to be impressed? The answer is no, because your friends don't know how much you had to invest in order to collect that $518. If I told my friends then that I had invested $1,000 to make $518 in return, they'd be mightily impressed. On the other hand, if I told them that I'd had to invest $1 million to make $518, they would not be impressed at all, because they could have done better than that with an FDIC insured savings account. So that's the problem with dollar returns. It doesn't give you any information about your return compared to the amount you had to invest to get that return. So now we need to look at a measure that takes care of this problem of comparison with the amount invested, and that's called percentage returns. And once again, we get returns from both dividends and capital gains. The percentage returns from dividends is called dividend yield. And we calculate the dividend yield as the dividend at the end of the year divided by the price of the share at the beginning of the year. That's what div sub t plus 1 means. Dividends a year from the time you purchase the stock. And p sub t is the price you pay for the stock. Basically, we're saying here, what kind of dividends am I going to receive compared to what I paid for that privilege at the beginning of the year? Now, the percentage returns from capital gains is called the capital gains yield. And how do we figure that? Well, we take the price from the end of the year and subtract the price at the beginning of the year, and then divide that by the price at the beginning of the year. Once again, we're comparing the gain with what we had to invest at the beginning of the year in order to receive that gain. So the total percentage return is just the dividend yield plus the capital gains yield. Let's use our numbers from previously to calculate the percentage returns. Remember we said that we get $1.85 for our investment of $37. So $1.85 is div t plus 1 and 37 is P1. If you do the math, that comes out to 0.05 or 5%. Our capital gains yield is just 40.33, that's the price at the end of the year, minus 37, that's the price at the beginning of the year, divide by 37, the price at the beginning of the year. If you do the math on that one, you get 0.09 or 9%. So how do we get total percentage returns? All we have to do is add dividend yield and capital gains yield. 5% plus 9% is equal to 14%. Now that's a little more impressive when you're talking to your friends at a party than just telling them that your portfolio had dollar returns of 518. Now, on the other hand, your friends don't know how much money you invested at this point. If you invested $100 and received 14%, then that's really not impressive. You've barely gotten enough to buy your own dinner at a decent restaurant. On the other hand, if you had invested $1 million and had a 14% return, you're $140,000 up. So both of these measures lack at least one piece of information. Now, let's check our work by dividing that total dollar return that we had earlier of 518 by the initial investment of $3,700, and lo and behold, it comes out to be 14%, so our math was correct.
Let's take a look at some returns for different kinds of assets in the real world. This chart stretches from December 31st, 1925 until December 31st, 2012. The reason it only goes back to basically January 1st, 1926 is because that is when we start to have reliable daily return data for stocks and bonds. Before that, the data is really not that great. So that's why this is the way it is. Now the next thing I want you to notice is this vertical axis is not 0, 10, 20, 30. It's 0, 1, 10, 100, 1,000, 10,000. This is called a logarithmic scale. And the reason that we use a logarithmic scale when doing a chart like this is so that a 10% return on the lower portion of the chart will be identical to a 10% return in the upper portion of the chart. They'll be the same distance. Otherwise, a 10% return, if we didn't use a logarithmic scale, a 10% return very high on the chart would be huge, and one very low on the chart would be very small. The purple line is inflation. How do we interpret this? The way we interpret this is that what $1 would buy you at the end of 1925 would have cost you $12.81 at the end of 2012. In other words, the dollar had lost its value to purchase goods over this time. My grandfather used to tell me about buying candy bars for a nickel in this time period of 1926 or so. And if you take a nickel times 13, you're up to about 65 cents. It's in the ballpark for what a candy bar would cost today. So that's our benchmark. Anything that returns more than that is going to have what we would call a positive real return. In other words, your investment is beating inflation if it's above that line. The green line that we see next are Treasury bills. This is the short-term debt of the United States government. Now, it's considered to be risk-free. Let's talk about what kinds of risk you have with debt. There is default risk, the risk the borrower will not pay, and then there's interest rate risk, the risk that the value of your investment will go down because interest rates have gone up. Treasury bills, in theory, are free from default risk because the United States government can always, in theory, raise taxes to pay their debts or print additional money. So in theory, Treasury bills are default risk free. They also suffer very little from interest rate risk because interest rate risk is exacerbated by the amount of time to maturity. So a 30-year bond would have plenty of interest rate risk, but a 3-month Treasury bill would have very little. And what we see here is that line showing Treasury bills is very smooth, and it gives us this nice smooth increase up to $20.57. In other words, if you would have invested in Treasury bills $1 in 1926, then by 2013 you would have had $20.57. That sounds pretty good until we look at long-term government bonds. The borrower is the same here, the United States government, so in theory the default risk is also the same, 0. The reason that long-term government bonds must return more is because of interest rate risk. People talk about bonds being safe. They're not safe, they're just safer than stocks. So here we have a little more risk because of that interest rate risk, and I want you to notice two things. Number one, that line is rougher, and we're going to start to see a pattern here that as we move up the chart, the lines become rougher and rougher. And this is a sign that these investments are riskier and riskier. We use the term volatility to discuss this roughness, and we say that the more volatile something is, the riskier it is. I want you to also notice that $1 invested in the beginning here would have yielded $123.12, which is over 6 times as much as investing in the Treasury bills. The reason you're getting that extra return is to compensate you for the risk of taking on that interest rate risk. Now, moving on up the chart, there's something missing here. There should be large company bonds next. And large company bonds should fall somewhere between long-term government bonds and large company stocks. And here's why. With large company bonds, not only do we have interest rate risk, we also have default risk because companies can go bankrupt. Yet those bonds will be safer than stocks because of the way things are paid out in firms. When a firm gets cash, the bondholders get paid first before the shareholders, whether that's during the normal operation of the firm or at bankruptcy when the assets are being liquidated. So then we see the large company stocks up here, and I want you to notice that this orange line is rougher than the green line of long-term government bonds, and that is because it is riskier. So once again, rougher equals riskier. And if you'd invested $1 in large company stocks back at the beginning, now you would have $3,532.56. That's huge compared to long-term government bonds. Why was the return on large company stocks so much greater? Because they are riskier. Risk and reward must go together. And finally, we have small company stocks. If you'd invested $1 in small company stocks back in the day, now you would have $18,364.60. Why are small companies riskier than large companies? Well, first of all, every large company, for the most part, started as a small company. Only the smart ones have survived to become large companies. And so if a company is large, it means they must have done something right somewhere along the way. Small companies, anyone can start one of those, and many of those will die before becoming large companies. And so the risk of buying small company stock is greater, so the reward must also be greater. And that's why we see such a high portfolio value at the end of this time period if you were invested in small company stocks. Also, large companies are frequently more diversified than small companies, and so you'll see that they have smoother earnings and are less volatile in their returns.
Here's another way to look at the riskiness of stocks. What we've done here is for each year we've put it into a bucket, and those buckets are 10% buckets. So for large company stocks, we see that, for instance, between 0 and 10% contains the years 2007, 2005, 1994, and so on. And when we stack the numbers up like this, what we get is called a histogram. And the wider this histogram is, the more real estate it covers on the horizontal axis, the more risky the underlying asset. Let's start by looking at large company stocks. The greatest return we see for large company stocks is between 50 and 60%. We see that for the years 1933 and 1934. Now, 1933 happened at the depths of the Great Depression. Why in the world would we have such a lovely return in 1933? Well, the answer is down here on the other end. Look what happened in 1931, down between 40 and 50%. In 1932, down between 0 and 10%. So this was kind of a bounce back from those years of previous losses. Now, is that always the case, that a year of really great returns follows years of poor returns? Well, let's look at 1954. Where is 1953? Well, 1953 is between 0 and -10, same as 1932. Now, if the pattern held, we would expect to see 1952 somewhere further on down here, but that is not the case. In fact, we see 1952 between 10 and 20% return. So it wasn't a bad year at all. Okay, now moving on to small company stocks. We've done the same thing down here, but it covers a much wider ground. So we've got between -60 and -50 down on the low end, and we've got between 140 and 150 on the top end. Now notice that the large company stocks kind of look like a normal distribution, but small company stocks not so much. So we've got a lot of riskiness here, and just eyeballing that would lead you to question the assumption of the normal distribution for stock returns for small companies. Now we know that risk and reward go together. The higher the risk, the greater the reward must be. So the riskier a security is, the greater the return must be. We saw that with small company stocks versus large company stocks versus bonds. And so we're going to come up with a concept here called the risk premium. And this is how to think about it. The risk-free asset provides the risk-free rate of return. Just because something has no risk whatsoever doesn't mean that it doesn't provide any return. So there's this base level of return that we refer to as the risk-free rate. But any return that you receive over and above that risk-free rate must be a compensation for bearing risk. And so that extra return is what we call the risk premium. Now, how do we calculate the risk premium? Well, it's actually quite easy. We take the return of the security and then we subtract out the risk-free rate.
So here are the assets we were looking at earlier on the chart, the logarithmic chart, with a few more assets added in. And these assets are sorted in descending order of return. In other words, the riskiest one is at the top, the safest one is at the bottom. Of course, we're not talking about inflation, we're talking about U.S. Treasury bills. Inflation is just there for a benchmark. Now, the average return on small company stocks was 16.5%. Compare that to the average return on large company stocks. As we mentioned earlier, small company stocks are riskier and therefore they must return more. And as we go down the line here, this ordering makes perfect sense because large company stocks are safer than small company stocks. And the bonds of those large corporations are safer than their stocks. The bonds only return 6.4%. And long-term government bonds should be safer than long-term corporate bonds, so it makes sense that they return less. And intermediate-term government bonds suffer less interest rate risk, so they should offer less return, and they do. And finally, at the bottom, we have the U.S. Treasury bill, which has no default risk, in theory, and also has very little interest rate risk, so it's got the lowest return of any asset here. So that all makes sense. Next, we want to look at standard deviation. As we're about to learn, standard deviation is our mathematical measure of risk. It measures that roughness that we talked about earlier. And small company stocks have a standard deviation of 32.3 compared to 20.2 for large company stocks. That makes sense. And large company stocks have a standard deviation of 20.2, which shows them to be riskier than long-term government bonds at 8.3, because higher standard deviation means greater risk. Now there is an anomaly here. An anomaly is something that theory can't explain. Take a look at the standard deviation on long-term government bonds. The standard deviation is higher than that for long-term corporate bonds. So this means, in theory, that long-term government bonds actually experience greater volatility than long-term corporate bonds. That doesn't make any sense given what we know about default risk. And look at the returns. The return on long-term corporate bonds matches with what our theory would predict, but the standard deviation does not. And so this is an anomaly that we are not going to be able to solve here today, which is something for you to notice. Moving on down, we see that the standard deviation of intermediate government bonds is lower than anything else we've looked at, and the lowest of all would be Treasury bills with 3.1. The next thing I want you to think about from this chart is risk premium. Remember earlier we said that the risk premium is the return on a risky asset minus the risk-free rate. We use the United States Treasury bill as our proxy or stand-in for the risk-free asset. And so the return on the U.S. Treasury bill is our proxy for the risk-free rate. Here it's 3.6%. So the risk premium on large company stocks would be 8.2%. How did I get that? 11.8 minus 3.6. And how do I get the risk premium for small company stocks? It would be 16.5 minus 3.6. And if my math is correct, I believe that would be 12.9%. The final thing we should look at are the distributions on the right-hand side. I want you to notice that the riskier something is, the broader the distribution is. In other words, the greater the proportion of high returns and proportion of low returns. So you see more things further away from the average return, the riskier the thing gets. Take a look at small company stocks, for example. They are spread out very wide. Now, as we go down to large company stocks, the distribution gets narrower, long-term government bonds and corporate bonds even narrower, and then get down to U.S. Treasury bills, and we have a very tall, skinny distribution. This is all consistent with what we know about risk.
So far, we have looked at graphical representations of the risk of securities. In the chart of returns from 1925 to 2010, we looked at the roughness or jumpiness of the line. And then in the histograms, we looked at the broadness of those histograms as a graphical indicator of risk. But we need to have some sort of mathematical way to measure risk. If you recall from your statistics class, variance and standard deviation are measures of dispersion about the mean. And dispersion about the mean is what we're talking about when we talk about risk in returns on financial securities. If something is very narrowly distributed around its mean return, it's not very risky at all. But if there's a wide distribution of returns around that mean return, then that's a risky asset. And so we can use, therefore, either variance or standard deviation as our measure of risk. Now the question is, which one do we use? And the answer is standard deviation, and here's why. The units of variance for returns of financial securities is percent squared. Have you ever heard anybody talking about percent squared as a unit? Now it's very confusing, and it's hard for us to comprehend what that means. However, if you take the square root of variance, you get standard deviation, and that's in percent, the same unit as returns. And so therefore, standard deviation is the perfect way for us to measure this risk of financial securities in a mathematically precise way. Okay, now we're going to learn how to calculate standard deviation. What we have here is a sample of 4 years worth of returns. We're going to calculate what's called a sample standard deviation. Anytime you see historical data, that's what you're going to calculate, sample standard deviation. And that's what we do when we look at returns back to 1925 and we want to calculate the standard deviation. It's always a sample standard deviation. And you'll see what the mathematical difference here is in a minute. So we've got 4 years worth of returns, and I've got them first in percentages and then in their decimal equivalents. And the first step is to calculate the arithmetic mean, which is what your mom probably called average. So we're just going to add those four things together, and I get 0.8576, and divide by 4. And I think that gives us 0.2144, or 21.44%. Feel free to pause the lecture and check my math. Okay, now that we have the mean, we can start calculating the deviations. Notice that I've dropped the percentages. We're only going to deal with decimals. We'll convert back to percentages at the end. We can calculate each year's deviation from the mean by taking that year's return and subtracting the mean return. Now, usually we would have that as an R with a bar over the top of it, but I couldn't figure out how to get the computer to do that. So I'm going to use the alternate R bar designation for the mean. And so if I take 0.137 and subtract 0.2144, recall that was our mean, I get 0.0774. And I do the same for the remaining data points there for the 3 years. Now be careful with something like year 4. You start with a negative and you subtract the mean, and so you're going to basically be adding two negative numbers together. Okay, now if at this point we added all those deviations together, I bet that we would end up with 0, and that's the way it should be. So it wouldn't be helpful for us to find out an average deviation because it would be 0. We need to somehow get rid of the differences between negative and positive because they all represent departures from the mean. How do I make a negative number positive? Well, one way I can do that is to square it. And so that's what we're doing over in the next column over, and that's deviation squared. Now here's a hint. Anytime you see 4 decimal places and you're going to square that, the square will have 8 numbers, 8 decimal places. If you're having a number like the third year, the deviation is 0.237, that's a 3-digit deviation, you'll wind up with 6 digits in the square. So when you're squaring something, always just look for twice the number of decimal points. Your calculator should already be set for 8 decimal points, but if it's not, go ahead and do that now. And if you don't know how to do that, Google it or send me an email. Okay, so what we're going to do is take all those squared deviations and add them together. And that number is called the sum of squared deviations, or SSD, sum of squared deviations. We're very close now. In order to figure out the variance, all I have to do is divide SSD by n minus 1. Well, what is n here? N is the number of years in your sample. In this case, it's 4. So n minus 1 is 3. So I'm going to take SSD divide by 3. And that gives me the variance. But is variance what we were looking for? No, we were looking for standard deviation. So how do I get from variance to standard deviation? It's quite simple. You just take the square root. I believe you have a button on your calculator for that. So just hit that button. And you're going to find out that the standard deviation is 0.2413. Now I've rounded that to 4 decimal places because that's our final answer. And when I put it into percentage format, it's going to be 24.13%. And remember, in this class, we're always looking for 2 decimal places, whether it's on money or on percentages. So 24.13% would be your final answer for what is the standard deviation of this set of returns.
Now we are going to learn how to use your TI-BA2 Plus to calculate sample standard deviation. I think you'll find it much simpler to do it with the calculator than to do it by hand as demonstrated in the video lecture. The first thing we need to do is to get this data into the calculator. We have 5 years of sample data here. Now notice this is sample data. The method I'm about to show you only works with sample data. It will not work with situations where you are given probabilities of different events in the economy and multiplied by the expected return in those situations. So this is purely for sample data. First thing we want to do, second, and the number 7, that says data right above it. We're going to enter some data. Now notice that I've already got something in here. This thing will remember what you put into it until something really dreadful happens or you clear it out. So here we go. Second, clear work. Do you see it says clear work right there? The reason we do that is if we have, say, 6 data points in here from previously, those extra data points are going to hang out there and just wait to mess up your mathematics and give you the wrong answer. So let's get our data entered. Let's enter it as decimal points. And the reason we want to do that is because when we calculate the variance, if we have it in percentages, we are going to be 4 decimal places off. So let's do it as decimals. 0.03, enter. That's x01. If you don't hit enter, it's like it didn't even happen. Your calculator will deny that you ever typed that number in. Arrow down, y01. This is for another data series. If we were looking at 2 different stocks here and how they perform with respect to each other, we would put that other stock in here at y01. But since we only have 1 stock, we're just going to leave that alone. Arrow down. x02 is 12%, but it's negative, so we say 0.12 plus minus, enter. Arrow down. Leave y02 alone because we're only looking at 1 stock. Arrow down again. The third year is 25%. 0.25, enter. Arrow down. Y03 we leave alone. Arrow down. The next year is 13%. 0.13, enter. Arrow down. Leave y04 alone. And our final year is also 13%, so 0.13, enter. Now we have all the data in there. We are ready to calculate some statistics. You want to hit the second button and then the number 8. Notice that above the number 8 it says stat. That's short for statistics. And this says lin, which I'm told stands for linear, but it doesn't matter to us. We just ignore that. Arrow down. N is equal to 5. We have 5 data points, so far, so good. Arrow down. X bar is equal to 0.084. That would be 8.4%. And that is exactly what Connect says the average, or the arithmetic average, or mean, is for this set of data. Arrow down again. The sample standard deviation is 13.81%, which matches perfectly with what Connect says. Now the next step is to figure out the variance. And what's the relationship between variance and standard deviation? Variance is merely standard deviation squared. But before I square this, I want to point something out. This equal sign lets you know that this number is what the calculator has found for this variable. As soon as I do something to that number, though, that equal sign disappears to let you know that this is not the sample standard deviation. Here is the variance, and notice it is exactly the same as Connect said it would be. So now we know how to use the calculator to find these things. Now I want to show you one more thing just to keep you from hurting yourself. If you arrow down one more, you see a lowercase sigma, which also stands for standard deviation. Now some people will see this and think, oh wow, that must be the standard deviation. This is a population standard deviation. we do not have the entire population of data. We only have a sample. Therefore, it would be inappropriate to use this number. The number we want is the sample standard deviation. And notice the equal sign is back and the original standard deviation is there too. Once more, if you see this, run screaming. That is not something we are going to be using in this class. Don't do it. This is the standard deviation that you want.
What can we do now that we know the standard deviation of a sample of returns? Well, we can develop a normal distribution for that particular sample. And this is the normal distribution right here. For the moment, just ignore that line of percentages on the very bottom, because everything above that is true for anything that is normally distributed. For instance, let's talk about IQ. The mean IQ is 100, and standard deviation for IQ is 15. Now, if you don't know what IQ is, it's a measure of intelligence, or one's raw mental horsepower. So that's what we're looking at here. We can use its intelligence is normally distributed. We find that lots of things in nature and business and science are normally distributed. So we can use this for lots of different things. We're going to start with using the intelligence idea, and then we'll get back to stock returns. Now, what do these things mean? The plus 1 sigma, plus 2 sigma, plus 3 sigma, and so forth. Well, sigma is the Greek letter we use to represent standard deviation. And so what the normal distribution really tells us is that, for instance, between minus 1 sigma and plus 1 sigma, we have 68.26% of all observations. So, using IQ, that means that between 85 and 115 IQ, that's where 68.26% of the world's population is. How did I come up with 85 and 115? Well, I took my mean of 100 and I subtracted 15, which was standard deviation, and that gave me the 85. And I took 100 and added 1 standard deviation. That gave me 115. So that's my minus 1 standard deviation to plus 1 standard deviation range. Once again, 68.26% of all people will fall between 85 and 115. Now, what if I ask you what percentage of people fall between 70 and 130 on IQ? Well, you could see that minus 2 standard deviation to plus 2 standard deviation contains 95.44% of all observations. And since standard deviation is 15, 15 times 2 is 30. So we're looking at 100 minus 30 is 70. 100 plus 30 is 130. So we've got 95.44% of all people between minus 2 standard deviation and plus 2 standard deviations. Now, what if I ask you what percentage of the world's population has an IQ greater than 145? Well, let's figure that out. Between minus 3 standard deviation and plus 3 standard deviation is 99.74%. Now what that means is there is 0.26% in the tails. Those are the leftovers. Now the normal distribution is symmetric about the mean. That means there's an equal amount in each of those tails. So what is 0.26% divided by 2? It would be 0.13%. And so what we're really saying is that 145 and greater would be 0.13% of the entire population. Now let's assume that you have an IQ of 145. Right now you're probably feeling pretty darn good about yourself, knowing that only 0.13% of the world's population is smarter than you. I want you to get out your calculator and we'll see what that really means. Put 0.13 divide by 100. That's to turn the percentage into a decimal. Now I want you to multiply that by 6 billion. That's 6 with 9 zeros after it. Why 6 billion? That's how many people are on the planet today. And if you hit the equal sign, you can see exactly how many people are smarter than you. It turns out, if your IQ is 145, there are 7.8 million people who are smarter than you. Do you feel so smart now? Probably not. Okay, so if you ever get to feeling too good about yourself, you can always do this little calculation. Now, let's take this back to stock returns. We've got returns on stocks here, and the mean is 11.8%. How do I know that's the mean? Because that's the highest point in the normal distribution. It's also marked with a 0. In other words, it's 0 standard deviations away from the mean. Now, it tells me that plus 1 standard deviation is 32.3%. How much is 1 standard deviation? Well, we can take 32.3 and subtract 11.8, and we come up with 20.5. Now that means I should be able to take 11.8, subtract 20.5, and get negative 8.7 as my minus 1 standard deviation, and I do. And so it's all looking pretty good. This works as it's supposed to. Now, what if I ask you what percent of years will have stock returns lower than 29.2% negative? Well, you can look and see that between 29.2% negative and 52.8% positive, we have 95.44% of all observations. How much does that mean is left in the tails? Well, 100 minus 95.44, I get 4.56%. Now, does that mean 4.56% of all observations are less than negative 29.2? No, remember that this is both tails, so we have to divide by 2. I get 2.28%. 2.28% of all observations are expected to be below minus 29.2%. And so these are some calculations that you'll need to practice because you'll definitely see this on an exam. Okay, let's talk about two different kinds of averages. We have the arithmetic and the geometric. Now, arithmetic mean or arithmetic average is the one that you know and love. It's where you just add the numbers together and divide by the number of numbers. Now, geometric average, however, is new to most students, and it's calculated in a very strange way. First of all, we take all of our returns in decimal form and add 1 to them. Then we multiply all those sums together, and then we take that to the 1 over n power, where n is the number of items that we're trying to average. Then we subtract 1. Why are we subtracting 1? Well, we added 1 to all these returns. We get to the end here, we need to subtract 1 to get it back to a return. And then I can multiply it by 100% if I want to put this into percent. Now, what is the purpose of the geometric average? Well, that's best demonstrated with an example. So here's that example. You have a portfolio that's worth $100 at time 0, $50 at time 1, and $75 at time 2. What are your annual returns? Well, we figure returns, we're talking about capital gains here. Well, we figure the returns by taking time 1 price minus time 0 price divided by time 0 price. So 50 minus 100 divided by 100 is minus 50% for year 1. Now, at year 2, we go from 50 up to 75. So the return for that year is 75 minus 50 divided by 50. That's a positive 50% return. Now, what is the arithmetic average of the returns for this portfolio? Well, minus 50% plus 50% is 0. And 0 divided by 2 is 0. So the arithmetic average is 0%. Now that doesn't sound quite right. I started with $100 and I wound up with 75. How in the world does that mean I had an average return of 0%? Well, this is where geometric average comes in. You see, arithmetic average doesn't take compounding into effect, but geometric average does. Let's demonstrate. We're going to add 1 to each one of these returns in decimal form. So that's 1 minus 0.5 multiplied by 1 plus 0.5. In other words, we've got 0.5 times 1.5. So inside those square brackets, that's 0.75. And we're going to take that to the 1/2 power. Folks, that's just like taking square root. So just go ahead and use your square root button there. Then subtract 1. At that point, what I get is minus 0.1340. If I multiply by 100%, I get minus 13.40%. Now, does that sound right? We can verify it. Get your calculator out, and first of all, do your second future value. That clears out the time value of money register. And then we want to put in 100 and hit that plus minus button and present value. And then we will do 75 for the future value. And that's 2n, 2 years. And then we'll compute I per y. And I get minus 13.40%. That makes perfect sense. We know the return on average should be negative. After all, our portfolio value went from 100 down to 75. So the question arises, when do I use arithmetic and when do I use geometric? So which average you use depends on what question you're trying to answer. The arithmetic average answers this question. What was your return in an average year over a particular period? Now, the arithmetic return is probably too high for longer periods if you're trying to come up with what's a true average return. And the geometric average answers the question, what was your average compound return per year over a particular period? And it's probably too low for shorter periods. So these are things to keep in mind as you decide which of these to talk about. I can't tell you this for certain though. When you are calculating variance and standard deviation, you always use the arithmetic average or arithmetic mean. Never use the geometric.
Let's talk about capital market efficiency. We call capital markets efficient if the current market prices fully reflect available information. In other words, if a new piece of information arrives, if that information is fully reflected quickly in stock prices and bond prices, then we say that that capital market is efficient. Now this is an important idea because if it's right, it has some pretty big meaning for investors. For example, if the market is efficient, can you pick up the Wall Street Journal in the morning and read it, and then by the end of the day make some stock investment decisions that will make you money over and above the risk-adjusted return that we would think you should be earning for that? The answer is no, because that information has already been impounded into the stock price by other investors. So why do we assume that markets should be efficient? Well, if available information shows that a stock is underpriced, what's going to happen is that rational investors will buy that stock, and the buying of stock will drive up the price to its correct value. Now we have to say here, within transactions costs. For example, it costs me $10 every time I trade shares through my broker. If I can't make more than $10 by purchasing the stock and driving it up to its correct value, then I won't do it. And so these prices are going to be correct within transactions costs. Now, if the available information shows that a stock is overpriced, rational investors are going to sell that stock. And you don't even truly have to own a stock in order to be able to sell it. You can do what we call short selling, where you borrow the shares from another investor sell them in the hopes of buying them back at a lower price to return to that investor from whom you borrowed them. But either way, whether you own these shares to begin with or you're short selling, that action will drive down the price of the stock. And enough people do this, and you wind up with the stock price being at its correct value, once again, within transactions costs. There are different forms of market efficiency. The lowest form, or weak form, market efficiency says that the current price contains all the information in it from past prices. And sometimes you'll also see trading volumes included in this information set. So let's just go ahead and throw that in there and say past prices and trading volumes. What does that mean? It means that we can't guess where the stock price is going by looking at a chart of previous prices, or even considering the trading volume. We wouldn't be able to predict where the stock price is going to go by looking at those past prices and volumes. This sounds like a pretty basic idea, but you'll hear of countless people who think that they can tell where a stock price is going by looking at a chart. And they see things that they call head and shoulders, and they've got all sorts of other patterns that they see in these prices. But the truth is, they're not seeing anything meaningful. It's just like when children lay on their backs on the ground and watch the clouds and can see different animals in the clouds. Those animals don't exist in reality, they are merely in the child's imagination. And the same thing is true for these patterns that these so-called technical analysts find in stock prices. The next form of efficiency we talk about is the semi-strong form. And this is where we say that stock prices contain all publicly available information. And so, of course, prices and volumes are publicly available information, so they would be included in this information set, as well as all financial releases from the company, all newspaper articles regarding the company, all information that had been shared out on the street by the employees of the company. All that information would be included in the stock price. So you couldn't make money over and above the expected risk-adjusted return by looking at the annual report of the company or by reading newspaper articles about the company, because that information would have already been impounded into the stock price by other market participants. And then the strongest form of market efficiency we talk about is called strong form, and that is where the price contains all public and private information. In other words, it contains all the information that we've talked about in the other two forms of market efficiency. Additionally, it also contains private information. Let me give you an example of how this would work. Let's say there's a researcher in the basement of a pharmaceutical company, and that researcher, who happens to be an investor in the company, finds the cure for AIDS. And upon finding the cure for AIDS, that's now private information. He, an investor, knows that the company now has the cure for AIDS. Under strong form efficiency, the stock price would immediately jump to the new level that reflects that information. But that doesn't sound very realistic based on what we know. Based on what we know, we think the market is semi-strong form efficient. In fact, United States securities laws are based on the idea that markets are semi-strong form efficient because they forbid the trading on inside private information. That prohibition is based on the assumption that trading on private information will give you returns over and above the risk-adjusted return that we would expect for the stock otherwise.